the tensions of war have sort of made a crescendo, and it affects everything in the world.
We only have 40 to 50 days worth of oil. We don't produce our own oil here. We're heavily reliant, 100%. Just keep in mind that volatility is normal. It's a part of it. And there is short-term volatility, but it always ends up going to the upside. 7 of the 10 best days occurs within 15 days of the 10 worst days. It's not a 30-day plan, it's a 30-year plan with KiwiSaver. One of my clients, over $1 million extra, just by making small tweaks.
Welcome back to the Blueprint Podcast, a place where everyday Kiwis can come to learn more about their finances. This is a very timely episode, a very dramatic episode.
Controversial, if you will.
The tensions of war have sort of made a crescendo, and it affects everything in the world. Obviously, first and foremost, the hot topic is energy. Obviously, people's safety is a large concern. And the general uncertainty floods into the economy, all right? And us here sitting in the bottom of the Pacific, you'd think we're not, have anything to do with that, but it's actually incredibly related to us.
Absolutely. We're a bit of a safe haven from the physical effects of war.
Yeah.
And today we talk about the economics a bit and the macro, as we alluded to earlier off camera. But certainly we're not desensitized to the people that are actually going through it in the forefront.
No,
exactly. It's not something we're going to be talking about, but our sympathies go out, and there's nothing good about war.
No.
But here we are. Hey, before we get too serious, can I just say, our company is made up of forwards and backs.
Yep.
And we have got the forward pack here today. We're close to 350 kegs of just prime beef here today.
Yeah,
so
yeah.
I tell you what, if we were going to war, I would want the three of us in the front line.
To be fair, it's a lot of meat to sort of get more surface area to get hit by a bullet or a rogue drone. Yeah.
That's right.
No, you're absolutely right. And we're here. We're grateful to have a friend of the show and, top KiwiSaver advisor here at Blueprint, Jono Smith, back on.
Thank you for having me.
Mate, thanks so much for coming back on. Rory and I have been planning out our year. We've always planned to get you on later on the year.
Yeah.
But now with what's going on, we're talking to our existing clients a lot about their investments and their KiwiSaver because it's a big concern, right? So we thought we can answer all these questions in a 60-minute window with Jono and sort of provide some general oversight on what's going on, how people can act, and obviously how they can get in touch for advice. So, mate, let's kick it off. Talk about my own personal situation, Rory, as well. We're sitting here refreshing our KiwiSavers. You shouldn't be looking at your investments every day, but we're taking a look, and we've had a pretty big correction, significant correction. So tell us what's going on and tell us what we can expect.
In terms of what's going on, obviously, you've got the wars, you've got uncertainty, you've got oil prices spiking, and that just uncertainty alone causes volatility. But just keep in mind that volatility is normal. It's a part of it. And there is short-term volatility, but it always ends up going to the side. So as long as you look at the long term, it's not a 30-day plan, it's a 30-year plan with KiwiSaver. So I'm keen to get into more detail with you.
So just to further frame, I guess, this episode and what we're going to be talking about, we're talking about global conflicts and how that can flow into sort of emotional reactions in terms of people's investments, but also the real physical implications around energy disruptions, how that affects inflation, interest rates, and ultimately for New Zealanders, our KiwiSaver balances and household finances. So with that being said, this recent conflict that's going on is a real disruption in the energy supply. Can you talk to us about that and how that's kind of affecting markets?
Yeah, sure. Everything relies on oil, essentially. It's almost as good as the US dollar. And everything's priced in the US dollar. And oil is something that impacts everything. So obviously starts off with transport, but it's an input cost that just flows into everything, food, day items, and when there's disruption with oil, it can slow down supply chains as well. It just means everything takes much longer for goods and services to be distributed throughout. And then that just leads to increased cost, which means businesses need to factor that in. So it's a form of tax, really. And then that flows through to the personal side as well. So this, it's a bit of a concern, but we've been through many of these sort of oil crises before. Oil can be one of those leading indicators of recessions too, so I can see why people are concerned, especially if it does get dragged out. Yeah, there's a bit of a battle at the moment around that and how long this is going to last. Yeah, we'll see what happens. Sort of a watch, worry, wait situation at the moment, but everyone's sort of fighting for themselves at the moment around the oil situation.
Yeah. I don't know if you can answer this, but obviously the Strait of Hormuz is impacted, and 20% of oil and gas, the global oil and gas, a fifth exactly, throws through that strait. And there's limited access now, as you know. I think some's getting through to China, but the majority of that flows to Asia. Why does a channel that's predominantly flowing to Asia affect global prices? That's something that I can't wrap my head around.
Well, 20% is quite significant.
Yeah.
And if it's flowing to China, they're just going to keep stockpiling it as well. It's going to keep stockpiling it. And it just means, again, 20% disruption. It's not fully closed. There is just restrictions at the moment. But yeah, here in New Zealand, we only have 40 to 50 days worth of oil. We don't produce our own oil here. We're heavily reliant 100% globally for the oil supply. So we're going to feel it a lot more than other countries. Other countries do stockpile it or they get their oil elsewhere. But that's why it's going to impact us more so. And we're already seeing that when we look at the petrol pump, I was factoring $2.50 at the start of the year. Now it's over $3, so that's already eating into transport costs straight away.
Yeah. We've got this incredible flow chart, exactly what you boys have been saying, that we've just put together with a very short sort of cause and effect summary that we'll just go through now. So we start off with war. War happens, bomb drops, oil supply risk immediately. Obviously, to mobilize your militaries to start, that costs a lot of oil. But then, supply lines are shut down in many cases, like we see in the Hormuz Strait. Energy prices rise because of this. Supply and demand. Freight, aviation, and logistics costs increase. It's way more expensive just to get stuff around the world. So we've got inflation just based on that. And every Kiwi knows exactly what happens. Inflation rises, interest rate cuts get delayed, interest rates get increased, global share market becomes volatile, KiwiSaver balance drop. Blueprint Finance, very sad.
KiwiSaver clients are not happy.
They're not happy.
So certain things happen very quickly, right? So markets react fast.
The next day.
Price of oil reacts quickly. So I think, you're talking $60 a barrel, and now we're plus 100.
Yeah.
So that happens really fast. But some of these other effects we might not see, right? Like interest rates, if things stabilize in a timely fashion, there's not necessarily, we're not, pushing the red alarm right now, are we?
Well, just for context, Rory, before we get over to Jono, give some clients an update on the mortgage market side. So
absolutely.
We've had an OCR hold was the last review earlier on this year. And now, just this week, all the banks have increased their residential rates. And the biggest indicator of that to happen is swap rate. So it's something as advisors we keep an eye on. Those swap rates have been increasing quite heavily, which is understandable with global uncertainty. First thing that happens, right? So swap rates have gone up. So have the interest rate costs, even though we haven't had any fluctuation on the OCR. So that's what's happened on the mortgage market. But yeah, press on, Jono. Is it a big concern? Red flag? Yeah.
I think I'll zoom out and then provide some numbers and just go back in history as well, because it's actually not all bad.
Yeah.
Obviously, war's not a good thing. But, if we just zoom out just even the last 5 to 6 years, obviously we had COVID. COVID could have been biochemical warfare, again, with tariffs, the financial warfare, or Russia invading Ukraine, again, there were sanctions there, financial warfare. So we're always in this battle. And when we just look at sort of the share market, when we look at the S&P 500, so top 500 companies in America, so that accounts for more than half of the global market. So I'll stick to the S&P 500. But if we have a look at sort of COVID 2020, markets dropped 30% in a month. So when things happen, they happen really quickly, right? You see the sharp decline. But this sharp decline always tends to be like an overreaction, which creates some sort of like mispricing, which also creates a lot of opportunities, especially for a lot of active managers in the marketplace that we work with. They will seek growth opportunities in the downturn, but also try to protect you from markets falling. And the way they do that is they can move to cash, lock in profits, and then they'll recycle and buy assets prices. But what I want to get to is in the last 5 to 6 years, we've had 3 bear markets. A bear market, just so for people that may not know what it is, it's just a decline of 20% in the market. And the reason why it's called a bear market is because when a bear attacks, they attack downwards. That's a bear market. And a bull market is bulls attack upwards. So markets fell 30%, but what happened is it took 6 months for the market to recover. So what tends to happen with these geopolitical tensions is that, yes, we have a sharp decline, which is your short-term volatility. But usually when you look a year later, the markets have fully recovered and actually gone to new highs. Then when we have a look at 2022, when Russia invaded Ukraine, again, that caused a lot of energy, oil disruptions as well. Also a lot about wheat. There was an issue there. Again, we had a market decline more than 20%. Now, if you look at 2025, not that long ago in April, Donald Trump came out with tariffs, another 20% decline. So we've had 3 bear markets in the last 5 to 6 years. But if we zoom out and we look at the very bottom of March 2020 to now March 2026, the S&P 500 is actually up 180%. So it just shows you it's like you can't time the market. You have to be in the market and ride it out. And one of the things I battle with clients, especially during this period of time, is they don't want to make a decision. They want to see how this plays out. Yeah. They're worried about what's going on. And the thing is, if you wait for peace, you will end up paying the price because the price is already priced in. Markets price this all in. I remember our first podcast, that was something you said, Dan. Yeah. And it's totally true. Markets are forward looking. So this is just how the nature of the markets work. And I just wanted to emphasize that these geopolitical tensions doesn't always have a negative impact for too long. It can actually create a lot of opportunity, especially if you keep buying in dollar cost averaging, buying at cheaper prices, your average cost reduces. And if you do have 10, 20, 30 years to run, again, you'll have more assets or more units within your KiwiSaver appreciate in a one time. Now, to provide color on sort of returns and how it works in terms of just looking at your percentages, if we look at the probability of markets being positive in one day, it's actually like 52 to 54%. So again, more than 50% of the time, markets are positive. When we zoom out 10 years, it ends up being 90 to 95%. Your average annualized return is positive. We zoom out 20 years, now it's almost 100% that you have a positive annualized return. What I'm saying is the probability of success or the probability of a positive outcome increases the longer your time frame for investing. So that's why I said before, it's not a 30-day plan, it's a 30-year plan. And if you're going to make changes based on short-term volatility, you're going to lose money, guaranteed. You're going to lock in losses. And that's why you just want to reach out to your advisor and have a chat around it.
So no one lost money over a 2-decade period?
Yeah, if you have a look at the bottom of the Great Depression, if you look at the .com, if you look at the GFC, these are all recent events. If you run it 20 years, S&P 500, positive annualized return. Yeah. You can't really say that for bonds, which is usually one of the safest asset classes. So it's very interesting, like risk and volatility and what is risk. Like people can mix the two quite a lot of the time. What's even interesting, I'll throw this question at you guys, is these are just geopolitical tensions. But what about the big wars, like the World War I's, the World War II's, the Gulf War, Korean War? If we take the start of the war to the end of the war, what do you think the average annualized return has been? Do you think it's positive? Do you think it's negative?
I mean, based on your clues you just gave us, I'd say it's positive. But
I would have said negative though.
Yeah.
From the beginning to the end of the war. Is that what you're saying?
That's right.
Yeah, because you'd think that as a decade, maybe it'd be positive. But for those 5 years,
you'd be dipping.
Give us the news. How much is it positive by?
So the interesting thing is that every single big war, the average annualized return has been positive, each of the wars.
Oh, wow. Yeah.
And it's been roughly, if you add it all up, get the average return 7 to 10%
per annum.
per annum.
Oh my goodness.
So wars are good for markets.
It's not a good thing, but bad news is
Bad
news can sometimes be good news for markets. So yes, the decline, there's still short-term volatility, there's still a lot of scare again, but over a long period of time, markets recover. You know what I mean? So it's just like most wars last 2, 3, 4 years, but there's a lot of spending that goes in the wars too, you know?
Yeah.
And that can lead to obviously
economies need to move to
money
finance wars.
printing.
Yeah.
The printer gets turned on.
Yeah.
And I say this just to like give some people some peace of mind. Like people think the sky's falling all the time. And the reality is when it comes to KiwiSaver, you know, it's very, very diversified. You know, you have different asset classes. You've got your cash, bonds, property, shares, alternative assets. Then you've got diversification within each of these asset classes in different sectors, different industries. Then geographically as well, you're in the US market, Europe, Asia, New Zealand, Australia. So what I'm saying is if any one sector, industry, country doesn't perform and doesn't have a huge impact on your KiwiSaver, there are other economy sectors that are doing well. So just to give you an example, last year, actually, Europe and Asia outperformed the US. So a lot of the active managers we used tactically moved their funds into different markets and went more defensive as well. And there's main reasons around that is that different economies are entering the interest rate cut or hike cycle at different times. Obviously here in New Zealand, we've just come from our interest rate cutting cycle. We're kind of getting to the bottom, whereas other economies like the US are only starting to cut. So there's this desync in interest rate cycles, and that can create opportunities elsewhere as well.
But the Fed's has indicated that they'll be pushing cuts out, right?
Yep. So markets are forward-looking. Again, when we look at the US economy, everything can change very quickly, but the unemployment is still okay. The unemployment rate, inflation is still under 3%. You know, things aren't a big concern, but obviously the oil situation can change that very quickly, you know? And just to kind of give a sort of a macro understanding around inflation, interest rates, central banks, and how they try to control everything, especially when we go back to COVID times when inflation took off, the tool that the central bank uses is monetary policy. What they want to do is hike interest rates. Because hiking interest rates, so increasing the interest rate, means that it disincentivizes borrowing and spending because things become more and more expensive. And also, if you increase the cost of borrowing, your mortgage repayments go up. You have less discretionary income to spend. So that's a way to restrict spending. And if we do that, what that will do is reduce the amount of money we can spend in the economy, which means goods and services have to come down to meet that level of pricing. And that's our way to do that. But now we're in a situation where, okay, you know, the Fed or here in New Zealand, they're trying to control two things. They're trying to have price stability, so trying to keep prices stable, which is inflation. We don't want inflation to skyrocket because that's really painful. But then also we want to keep unemployment quite low as well. And it's two different things. And it's like, okay, what do you prioritize? Because you can't actually do both at the same time, which is where we are today. You know, we're in this market where people are like, is interest rates going up and they go down? Is it going to stay where it is? It's a fight between two things here. Because here in New Zealand, unemployment is quite high. We're at a decade high. And then if we look at interest rates, again, we've had some recent, like what you're talking about, the wholesale rates, what's happening overseas. We've had potential interest rate hikes being pulled forward. So interest rate hikes were scheduled to happen in 2027. It's been pulled forward to this year. So we could potentially see a hike. But what does that do to unemployment if we do that? You know, so it's hard, man.
It's a really interesting spot, isn't it? Because we've been in one of the longest recessions in the last 100 years for New Zealand. You know, it's really kind of gone on since 2020, and we've felt it quite deeply compared to Australia, who has sort of boomed through it. You know, real estate prices have all sort of grown through. Their economy has done quite well during the last 5 years. And now they're at the point where they're really experiencing a similar level of inflation that we had back in 2022 and 23. So as price takers, as the neighboring country who's still not at that point of recovery, you know, like you said, record high unemployment, and no one could say our economy is quite flash. It is sort of a what do you do situation. and a lot of uncertainty in the New Zealand markets, which we'll talk about in a second. But just touching on the points that you made with the changes on those fluctuations before we move on. So we always say, and we said in our last podcast, that the investment market and your KiwiSaver is a great place to store your money, and it's a horrible place to make. Yep. Right? So we're just constantly dealing with all these fluctuations and these changes. And we just want to reaffirm to our clients, as just the tagline for the episode, steady the ship.
Yeah.
Please don't make any dramatic changes, especially if you're an aggressive or growth fund.
Yeah.
Definitely have a chat to Jono, our expert advisor, to get some personalized advice. If you're making that consideration, maybe you might already be in the wrong fund and jump into another aggressive or growth fund. But you want to really stay away from crystallizing that correction at this point, and just like we always say, ride the storm out.
I like to use analogies. Like when I said volatility is normal, this short-term volatility is absolutely normal.
Yeah.
And the way I like to explain it is like, okay, what's the probability of the sun coming up tomorrow?
Yeah.
That's 100%.
Yeah.
In terms of evidence, it's come up every day.
Yeah.
And then I rock up to work. With markets, volatility is happening every day.
Yeah.
It's either going up or
They're
down.
They're just looking for
an
excuse. And this time it's the Iran conflict.
That's right.
Yeah.
Hey, I've got a question and then a confession to make. Question. When you talk about crystallizing losses in KiwiSaver, it's around changing funds, right?
Yes.
So it's basically going from aggressive to balanced, conservative, something like that.
Yeah.
Where you completely change strategy.
Yes.
And then when the recovery inevitably comes, you miss the bounce. Correct?
That's right.
Okay. I answered my own question. I actually made some changes to my KiwiSaver yesterday.
Oh, yeah? What did you go for?
No.
Did you go more aggressive?
Mate.
By the dip?
You didn't put it in
I've got a lot of tech exposure.
Okay.
You felt a bit exposed. You felt a bit naked.
Yeah, I did. And I just really started thinking about what I think is really important. Energy was one.
Cool.
I moved into energy.
Right.
And some silver and gold.
Yes.
And I was already quite, there's some crypto Bitcoin exposure in my portfolio as well. Essentially, I've just acted as an active manager, haven't I?
Yeah. What you've
Change
done,
of strategy, but not crystallizing losses.
That's right. What I can talk a bit about this. So
sorry to interrupt. You probably crystallized some losses, mate. But yeah, Jono, keep going.
I'll tell you what, though, I've been a bit scared. Iran is sort of saying the wars are so different now. There's a couple of threats. It's like nuclear as the big one, and then the other one is now these like targeting of infrastructure. Iran, where they produce all the oil, they've targeted that, and Iran is saying, well, we'll do the same. We'll start charging oil infrastructure in the Middle East, and also like data centers. A lot of these big tech companies have got big data infrastructure and cloud factories in the Middle East. And I just started thinking, that's going to not be good for my high tech exposure. I need to make some changes here.
Yeah.
I need some hard assets. I need some gold and silver, A little bit of a hit.
This is incredible. This is being unveiled in the podcast.
Live financial advice.
The truth of the matter is that you went against the exact advice that we just came here to.
I told you it was a confession. And this is. There's going to be people out.
I mean, how dare you? You know what I mean? How dare you do that without consulting us?
I know.
I'll link that back to KiwiSaver and the different options that are available. So what Rory's doing, just for people at home, is he's a DIY, do-it-your-own investor. So you can customize your own KiwiSaver and have control over where your money's invested.
Arrogant.
I would only suggest that for people that totally understand what they're doing, And what Rory's actually doing is what we call tactical asset allocation. He's seeing what's happening and tactically moving his money where he thinks will do well. Obviously, renewable energies, if there's an oil issue, you got to shift to more renewable energies. It makes sense. So he's acting on what he thinks might transpire over the next 12 months. Whereas a lot of managers out there are active managers. So what they're doing is they're professionally managing it on your behalf. So it's more, hands off for everyday Kiwis. And they have a portfolio manager. They're having a big investment team, and they're analyzing markets day and night, every single market when it wakes up. So what I could say is Rory's going to be not sleeping very well if his plays go wrong.
I mean, most importantly, sorry to interrupt, they've got the track record, these active managers.
That's right.
Yep.
So in terms of what some of the active managers are doing at the moment is during periods like this, to reduce the risk, is they will move into more defensive assets. So moving into cash, selling some of the, banking the profits. They will use sort of currency hedging as well. And there's just different ways. They're also investing in like more defensive income producing sectors like energy companies, like your power companies, because regardless of the economy, that's right. Regardless of the economy, you still have to turn the light on. So they are going defensive, and they are tending to underweight some of the exposure to equities or risky assets.
I mean, energy is just such a big thing.
Man, we're going to need a strategy session today.
We can't touch it again. No way we're touching it again. We're going to leave it now. And that's going to be it for the next 20 years, all right? Because we're done with this.
No, he's going to change it next month, mate.
Yeah.
No.
I'm not happy.
I'm pretty happy with my portfolio now. I had another really good think about it.
Yeah.
And I'm not going to dwell on it too much. But I was just to the energy point, New Zealand on hand, 50 days worth of oil.
Yeah.
And Nicola Willis said we've got about another 40 days worth on the boats in transit.
She's
For
got
3 months.
She's got it. Yeah.
We that's pretty lean, Like if we got cut off, I think we should be out there on the boats and dropping the rigs and becoming self-sufficient.
My God.
On energy or renewable, using more of the wind, more of the sun.
Mate, Greenpeace is going to storm in
Uranium.
here any minute. Oh, you want to set up nuclear power plants in New Zealand? Yeah,
absolutely.
Yeah.
You don't want to be relying on other countries for energy. But it's probably like the big leg up that Australia's got, right?
I think
big energy.
I think you are sort of. I think you're 100% right. I think any country, if they can be as self-sufficient as possible, that's great. But we're a small country, and we get to lean on these superpowers. We got the States and across the Pacific, and then we've got Australia and Indonesia, who we can really lean on for their reserves as well. So, yeah,
most of our oil is coming from sort of Asia anyway, Singapore, South Korea, Asia Pacific. Yeah. But yeah, it's a shame. Our latest refinery stopped in 2022 when I had a look. So I don't know, maybe we need to change that,
Do we run out or we just decide to pull pin?
I think we need to reduce the taxes on the petrol pump, mate. I don't know why we're not doing that. We need some relief.
We're not a government. We're just informing the folks what they can or can't do. And first lesson is, as much as we trust Rory, and Rory's, his points are common sense. So we love it. We love, and the KiwiSaver, it's yours. You get to play around with it. But we would advise people who are already following an active manager to steer the course and stay with it. We just talked about active. We'll quickly talk about passive as well, because it's always good to touch on this for the folks at home who don't know. So passive, this is generally, if you're with a default KiwiSaver provider, you will be under a passive fund, right? And that means they buy a diversified portfolio and they just set and forget, right? And so what we've found is when there's corrections come, the passives can often take the bigger hits because there's no safety measures in place, or there's no quick thinking or quick actions to put a backstop in to prevent quite a large dip in the portfolio. Is that correct?
Yeah, I'll explain both quickly, but passive is, like you said, a buy and hold strategy. You're investing in the broader market.
Yeah.
And generally over time, markets tend to go up more than they go down. But with a passive fund, there is fees and taxes involved as well. So you always slightly underperform the market. So a bit of a tracking error there. When you look at the studies, most people say passive managers tend to outperform because it is very hard to outperform the markets consistently. But it doesn't mean that there isn't any active managers that can do that.
Yeah.
Like, look at Berkshire Hathaway, Warren Buffett. He's consistently outperformed, the market.
That's right.
And here in New Zealand, when we look at the statistics around active versus passive, active managers have outperformed, mainly because the world is becoming more dynamic, right? There's a lot more recessions, corrections. Even if we look at sort of traditional finance, we've got sort of DeFi coming in as well and different asset classes kicking in. That changes things. And so we want to be able to be in a manager that can start to allocate in different areas as well. So there's no issue with the passive approach. I actually use passive managers as well. And we tend to sometimes use both active and passive. So going multi-style and sometimes using different managers and going multi-manager. So there's another way to diversify and spread your risk. There's a lot of people that are worried about risk or loss of capital. So when I have that conversation, okay, I'm looking at what's important. Is it managing risk? Is it performance? Is it fees? Because if it's fees, you're going to go passive. Passive is low cost. But if you want performance and and you want to manage risk, then active managers are doing a better job right now. But both approaches can get to your goal, and we both use both here at Lipman Finance.
That was really good, though. We'll move on to...
That was really good. Can I ask another question?
Yeah.
Really related?
Yeah. Mate, we're not going to change your KiwiSaver right now.
Do ethical funds get outperformed by non-ethical funds? For example, like wartime.
That's a great question.
Good question. Because KiwiSaver is a government product, there is some oversight. So all KiwiSaver providers are actually investing ethically. And now when we look at that, it's really hard to define ethical investing. To be honest, there's just more providers. There's some providers out there that can have a lean towards more ethical investing. So renewable energy, for example. There is a site called Mindful Money. I'll run clients through this as well, and we'll show the percentages that could fall into like human rights, weapons. And it could be indirectly, like we've got some companies that might make like blades for helicopters, but they can be used in military warfare. That's an indirect, or some company could create a part that's used in a gun, but it's also used in other things. So sometimes it's very indirect. In terms of performance, if oil is taking off and doing a lot more drilling, then that could impact, the more ethical options, the more renewable energy options. But again, when we zoom out and look at the long term, there's going to be periods where, more ethical providers outperform. So that comes down to your personal preference and your values. So I've got clients here that like, okay, I don't want to touch any of this. So I'll run through all the securities. I'll run through where the money's invested. I'll show them exactly where their money is invested. And once they realize where their money is, they want to make a change straight away. So if you want to know where your money's invested, how it's performing, what the fees are, honestly, get in touch with us. And you'll be surprised. You'll learn a lot.
Yeah. Because most portfolios have at least, 200 different securities, most of them, or
easily,
sometimes even much more than that?
Yeah. Easily. Yes, in terms of your strategy, like I had a chat to one of your clients yesterday, and they were like 95% invested in equities, 30 plus years to run, wasn't relying on KiwiSaver at all.
So quite an aggressive position.
They could retire today.
Yeah.
They had the assets, they could sell it down. So I was like, okay, well, let's just go pure 100% equity play. Maybe let's use leverage, like we're doing property and go 1.2, 1.5 times. Let's just bump it up, So there's things you can do to amplify your returns. Obviously, using leverage can amplify it the other way. But he was all on board because he knew if we invest for a 30-year period, the expected returns from equities or through leveraging, the potential returns.
To take the risk.
He has the risk capacity for it.
Yeah.
So it all depends. So we went 100%. And when you go 100%, basically you're investing in a single asset now. You're still diversified within that asset, but you don't have cash, you don't have property, you don't have bonds. But shares are a lot more tax efficient as well. So he liked that part. Obviously, I'm not a tax consultant, but in KiwiSaver, there's fees that can affect your performance. There's taxes that can affect your performance and how much growth to income assets you own. So getting that strategic allocation right, how much equities to income assets that you have does impact the overall performance. But it depends on the goal. Sometimes you don't want to be taking that much risk if you don't need to, For this client, and 120, 150%, he's happy.
Yeah, nice.
That's so exciting. And can we talk specifically about New Zealand markets? What was the statistic for most of our KiwiSaver providers were global equities versus domestic. I think it was 60-40, or what was that?
So I'll just talk about a typical growth fund.
Yeah.
So that is it's an 80-20 portfolio. So what it means is 80% is invested in growth assets, which is shares and property.
Yes.
Now, of that 80%, typically you'll have 50 to 60% of that. So if you think you've got $10, $8 is in growth assets.
Yeah.
Of that $8, you got $4 to $5 invested internationally in companies like Facebook, Google, Amazon, these high-flying companies.
And international, Japanese,
that's right.
British.
We've got global. We've got the US, we've got Asia, we've got Europe. We also have emerging markets, so Brazil, India, so developed and emerging. And then about 20 to 30% is allocated to Australasia. So that's New Zealand here and Australia. Now people go, why invest in New Zealand? Our economy is not moving anywhere. One of the pure advantages of investing here in New Zealand is there's no capital gains tax applied to any investment return. And a lot of these companies do pay the tax when it comes to paying dividends as well. The tax can eat into your overall financial outcome. And so investing here in New Zealand, there are benefits from just a tax point of view. And also in Australia, a lot of those equities out there as well, no tax applies.
Oh.
But there's benefits, man. And that's why, and if we actually zoom out over the last 100 years, we'll be fascinated to see this. The New Zealand, Australian market, in terms of average analyzed return, has been very, very close to the US.
Really?
Very close. Like we think, New Zealand are going to get 4%, 3%. Nah, man. You look at it as right there.
What, the NZX 50?
Yep.
Wow.
NZX 50, the ASX 200.
Because the last 10 years haven't really been comparable.
That's right.
And
that's why you want to be in different markets at all times.
That is super interesting. And that's encouraging to know that the longer term, we're actually doing quite well.
That's right. If you zoom out, that's what I'm saying. Like you want to be with an active manager that can move your funds into different markets.
Oh, that's really good to know. Tax benefits, obviously we're not accountants, so chat with your accountant, but mostly the big ones are diversification because New Zealand markets have underperformed in the last 8 or 7 years compared to the S&P 500, but you zoom out, in pretty good stead.
100%.
Yeah.
And that means that there's a lot of opportunity here in New Zealand too.
And that's why, in bad downturns where it might dip 20, 30%, that's buffered because of the diversification, right? Like there's companies within a diversified portfolio that outperform in down markets.
Yeah.
But that are actually taking a lot of heat off that bear trend,
I'll just explain diversification because these are just terms. People hear it all the time. But just to keep it simple, it's like spreading your eggs into different baskets. Another way to explain is diversification doesn't eliminate risk, but what it does is it reduces risk relative to the return you can get. So you could almost half your risk and get almost 80% of the upside, So it's just like, okay, it's worth it, If you do a Rory approach and put everything into one sector and that doesn't do well, you're not going to be very happy the next day. So,
mate, it's all about time in the market. Have conviction. There's nothing wrong with having conviction in a sector either.
Nah, 100%. There's different ways you can do it, Yeah.
So we got some good headlines on price since the conflict actually kicked off in late February. S&P is down 3.6%, Dow Jones 4.8%, South Korea down 11%, and then you got some commodities as well, which are really having a correction. But great stat here from Rory, Bitcoin's gone up.
Yeah, well, it's interesting. I brought that up with you guys, right? Bitcoin since late February.
Yeah, it's gone up.
But if you actually zoom back a little bit,
it's had a bit of a hiding, isn't it?
It's had a bit of a hiding, and the first bomb in Iran was dropped last year. When they were trying to wipe out their nuclear capability
around February,
and markets reacted then as well. And so, in the month or so, there's been dips, but they've been relatively they haven't been that bad. Right? Asia's South Korea 11%. Asia's dropped a little bit, but 3-4% for US, New Zealand, Australia. It's not that bad.
So you're saying this whole thing's already kind of been priced in, right?
Priced in. Like we've brought up Bitcoin before, but it is one of those new assets where it is still speculative asset right now, and you got to understand that if you're investing in that asset class, expect the 40, the 70, the 80% decline. Again, that's quite normal in that asset class. So, I'm not worried.
It's a beautiful thing though, isn't it?
Yeah. Man, it's a 30-year plan, not a 30-day
it's
plan,
money
guys.
powered by energy. Hey?
And
I love it.
to international markets, I mean, obviously, when prices go up, we're a bigger export country, so there could be some positive effects for New Zealand as exporters, right? Costs will go up. We might make a bit more revenue in terms of our exporters, so that's good. Seen some big headlines, Americans buying up real estate in our country. So obviously there's a bit of instability, perhaps not happy with the government, perhaps scared of the assured mutual destruction of the nuclear warheads. Just saw a sale up north for $5 million of luxury real estate.
Is that new rule where people can buy property in New Zealand over a certain...
That's 10 mil. So you have to, if you're non-resident, you'd have to bring 10 mil into the country, and then you can essentially get a PR if you're investing into businesses and real estate, $10 million.
Right.
So it must be, right? Unless they've got some residency already.
Yeah.
This person that the headline was about. But yeah, $10 million can buy you a ticket to be
pretty
obviously,
pricey,
and I think maybe a bit of a criminal check as well, hopefully.
Wasn't Trumpy selling green cards for $5 million?
Yeah. Well, that's US. Yeah.
I mean, I could touch on that. There is a lot of talk of trying to find another base, just in case, recessions, wars, they're trying to find another home, like safe haven.
And we're the backup.
We're so isolated, we're far away. So that creates opportunity for us too, Lots of high net worth clients coming through, coming to our country, and that's only going to be good for us long term.
And there's not a lot to gain by, invading New Zealand.
Nah.
I mean, we've got,
sheep.
good beef. Yeah, good beef and dairy, but we sell that all anyway.
We give the premium stuff away.
Yeah. But I mean, you see, since the war's been kicked off, you see all these rankings, and we're ranked as sort of number 1 or 3 as the safest country. So, I mean, obviously people believe in things like real estate, the family home, insurance. Security is the number 1 concern for most people.
Yeah.
So it is a commodity in a sense that we've got to sell. We've got to export. And
true.
And these sorts of times, hopefully it's good news for our country. But anything we haven't really touched on, guys? I'm just thinking, the tagline obviously is KiwiSaver in warfare. But you've just given us the news to steady the ship.
Yeah.
But we've got a soldier here who's gone a bit AWOL. He's sort of, he's defected and he's self-managing.
Yeah,
this is really not advised, mate. It's like sort of...
And it was late last night.
Yeah.
1 o'clock.
No, we're not happy.
I knew I was coming to see Jono. I just couldn't wait.
No, off air, we're going to sort of tell you how we really feel.
Show me your portfolio.
Yeah. We're going to give you absolute dressing down off air. But now for everybody else, please, if you've already got a strategy, stick to the script. All right? And if you're concerned or never had a strategy, just like COVID, we had so many people, reaching out or them wanting to educate themselves. We had those massive corrections at the start of COVID. Remember, wasn't it 10, 15%? Everyone's portfolio saying, I lost $4,000. And that's when people actually started to educate themselves. So it's another opportunity for education.
And dollar cost averaging, we haven't mentioned that.
Yeah.
You mentioned opportunity. We're contributing regularly on your pay cycle. So you're buying the dip.
Yeah.
It's great. One of the things that I'm interested in is a company called Strategy, which is basically like a levered Bitcoin play.
Strategy.
And I started like a lot of people do, taking an interest during the peak of the market and putting some of my powder in and taking a big hit. But I've had to stick with the conviction, and I said actually to Jono during Bitcoin, I hope it dips, so I can get it at a discount.
And here it's
But
come.
you're sort of deep down, maybe you don't. But it did. And so now the opportunity is to get a discount.
I love that. I just wanted to make a quick disclaimer to the folks at home. Rory is a bit rogue. He's our sort of rogue investor. And where this is not financial advice we're giving, we suggest you to talk to the professionals like Jono. And we always suggest a balanced approach. But we love the aggressive approach. I'm not trying to talk that down.
I'll talk to a few numbers that will help with some of the things you're just talking about. What's interesting, one of the providers put something out, 125-year time frame. Obviously, that's much longer than
the human life.
The human life. So if we look back, literally what it says here is the average annualized return. We're looking at S&P 500, 10.6%. Now, if you're trying to time the market, if you miss the 10 best days, your return drops to 6.37. And if you miss the 20 best days, it drops to 3.969.
Oh my God.
And if it's 30,
those are just days.
Those are days.
Those are days.
Where it just went down.
And if it's 30 days, it's 1.53%.
So you're better just putting your money in the bank.
Just keep investing, dollar cost averaging, regardless of the market's up, down, or sideways. Keep investing. And 74% of the years is positive. And 26% of the years are negative. So like I was talking about that rolling 20 and 30-year period, if your time frame is 20, 30 years, don't let fear make you change your decision.
Stay bored. Those 30 days, mark my words, some of them bounces off the bottom.
That's right.
Yeah.
So when you've sold on the way down to preserve, then you miss the bounce.
That's right here. 7 of the 10 best days occurs within 15 days of the 10 worst days. So when things go down, they eventually have to go up.
I wonder if you can tell that anecdote, because you have an incredible story about a client at your previous firm where they had their funds invested for over a period of 15 years, but they made 2 incredibly poor decisions that just sort of counteracted exactly what you're saying. So do you remember?
I won't remember all the details, but I remember enough to put it together.
Yeah.
So literally this client was invested for 15, maybe 20 years. And got to the point where this particular client became quite elderly, vulnerable, couldn't really remember too much. And then the daughter gave me a call. And he would have invested a couple of $100,000 back then, which would have been a lot of money. And the balance was lower than the initial lump sum. And she's like, how's this possible? I'm seeing the market's going up over time. How did this even happen? So what? And I was like, the only way this could have happened is if they sold at the dip, and locked in losses. Or maybe there were some withdrawals along the way, but I'll have a look into it. And I looked into it, and this particular client, I couldn't believe it. I believe there was like a Europe oil crisis. Literally, the markets dropped, and they sold right at the bottom of the market.
Sold. Yep.
All right. And then they moved out of these. They basically sold all the equities and then moved more into income.
So they didn't actually sell the asset; they just transferred it into a safer.
Which is a way of selling it.
Yeah.
Because you have to sell
You're
it.
selling it, right? Yeah.
Then things improved and like, oh gosh, I'm going to miss all this gains from the equity, the rebound, because generally what happens when we zoom out, markets take 3 to 5 years to fully recover on average. These recoveries actually happen very quickly. And what ended up happening is, again, the same thing happened. GFC kicked in. Mortgage-backed securities impacted the investment portfolio and sold at the very bottom twice. And this is selling tens of thousands of dollars of losses and booking them and switching from, your higher risk growth assets into income, making switches based on an emotion. And when I look at when they did it, they went through a good period of pain. It was like dragging on. Like GFC was a couple of years, and then they're like, I can't take this anymore, sell. And I had to tell her, this is what happened.
It was just a series of bad decisions. And obviously those were self-inflicted, right? Because they would have just gone and made the call themselves, moved it themselves.
And when I look at the notes, the advisor was saying, hold the course.
Yeah.
Hold the course.
And they ignored the advice.
Advice.
Oh, no, mate.
But lots of people did that during COVID.
Yeah. Just do nothing. Just sit on your hands and read a book, or which is hard as it is.
Mate, just pass that on to me.
Yeah.
Mate, I'll just keep you in touch and give you a call and make sure you're all sweet.
Yeah.
Hey, mate. So,
it's a cautionary tale. That's why I love that story. It's obviously horrible what happened to the family, but very important cautionary tale.
Absolutely.
Yeah.
The question for our KiwiSaver clients is not do markets move during wars and pandemics and financial crisis, but do you stay invested through them?
100%.
That's the important thing, right?
Like I just said, every major war, positive annualized return. Every geopolitical tension, we've had heaps in the last 5 years. Literally, in the last 5 years, 180% return. You would have doubled your money. You did nothing. Mate, just do nothing. Double your money. I'll take it from 50 to 100 grand if you just sit there and do nothing.
But keep contributing, please.
Keep dollar cost averaging. Obviously, employer, employee, government contributions, they'll be much higher. And then we'll double it again, 100 to 200. You've got the time. Stop selling them and locking in losses.
Yeah.
And another incredible prospect coming up before we wrap up, increase in contributions, mandatory from the government. That was an idea as a next policy for next year from the national government.
Yes.
Obviously, you're a big fan. I'm a big fan. Rory's a big fan.
Huge fan.
Yeah.
Yeah, I could talk about that. So it's 3.5% next 1st April coming up.
It's locked in.
Brilliant.
Oh,
is it?
Yeah,
That's great news.
It's going to roll in literally next month. The 3.5 employer and employee. And then from 2028, 1st April, will go to 4 and 4.
Yeah.
They're already talking about by 2032, that'll be 6 and 6.
So
when we run the numbers in KiwiSaver, we do need closer to a 10% contribution to actually achieve like a fully funded retirement. Make sure that you have enough to meet your ongoing expenses. Because the reality is the NZ Super isn't enough and there's actually a shortfall. And that shortfall, you either bridge it through KiwiSaver or other investments.
Yeah.
So I'm taking clients through this retirement planning and seeing what the gap is. I'm not just telling you what provider is suitable, what fund type strategy is suitable. I'm also talking to you about your income. How much income would you like throughout retirement? And is it enough? You know, like, do we need to take more risk? Do we need to contribute more now? Because there's no point delaying it another 10, 20 years because you want time to be on your side.
Got to be 10%, eh? It's in the richest man of Babylon.
Yeah. Depending on your age, if you're in your early 20s or 30s, it doesn't have to be because the time of compounding. The 10 doubles from $1 million. So like if you have a 30, 40 year time frame, you'll have enough doubles. 10% return doubles your money in 7 years. Over a 30, 40 year period, you have literally 5, 6 doubles in there. 100 goes to 200, 200 to 400, 400 to 800, 800 to 1.6 mil. Most of my clients will end up with more than $1 million. Sometimes a couple million. Some of my clients have been able to get more than $500,000 extra. One of my clients, over $1 million extra, just by making small tweaks. And when I run it through them, people go, oh my God, my KiwiSaver is only 30,000. This makes no sense. Like, how does it get to that big? It's the snowball effect, you know? It's the compounding. It's interest on interest.
Beautiful, mate. That's some great outcomes.
I mean, all they've got to do is stick to the strategy, but keep the contributions up. That's the key thing. Because the assumptions that we're making is that the contributions are going to stay the same. So because some people, they take KiwiSaver holidays, they forget about it, but it's just, you just need to have that consistency for it to really blossom in that sort of $1 million territory, for sure.
And the sooner we can get you in a home, just a plug on the mortgage end, the sooner we can sort out your retirement.
Yeah, no, for sure.
Yeah,
absolutely. I mean, it's great to see some of these clients who emptied it for the first home, and then now Jono does a great job. He follows up with them and says, okay, what's the strategy now? Because now this KiwiSaver is not for, we can get out of the cash and get back onto a aggressive or growth strategy, right? Because you've got a 30 or 20 year time horizon till you retire. Let's work towards something long term. Mate, this has been so good. Did we have any last minute stuff for Jono, sorry?
Mate, I don't think so. I think you've covered it pretty well. I think stay the course and let's just hope for a ceasefire, global ceasefire and back to normality.
Well, rest assured the boys at Blueprint are pushing for a ceasefire. So whatever that means for the global.
Mate. We don't want to get called to duty.
No. I think we're a bit too old for the draft now, maybe.
Funny.
What I do hope that this was like formative. People are stressing enough. People are going through a lot of the finances side. Like, must see, use your advisor. The statistics show using an advisor leads to better financial outcomes.
That's true.
In the KiwiSaver space, it actually leads to 1 to 3% additional return. That could be tens of thousands. Like, don't need to know it all. I don't know a lot about a lot of things. I lean on everybody. So just, reach out to your advisor.
Leave to the experts.
Most of what we do is free.
Yeah. No, brilliant, Jono. We really appreciate having you on. And it's just been such a great insight. You take such good care of our customers. Some might say you care a bit too much. No, it's just jokes. There's no such thing. But
it is true, though.
Yeah. But no, we're lucky to have you, mate, and keep up the good work. And yeah, we'll see you on the next step, guys.
Absolutely.
Cheers.